Welcome to Why Investors Fund Cash-Burning Companies, Beyond the Profit and Loss. This video explains how venture capital and private equity firms invest in companies that aren't yet profitable. Let's dive in. Have you ever wondered why successful investment firms pour money into companies that are actively losing money, showing a negative profit and loss statement? It seems counterintuitive, right? Today, we're going to demystify this fascinating aspect of private market investing, particularly in the venture capital and private equity world. A cash-burning business essentially spends more money than it earns, resulting in a negative P&L. This isn't always a sign of failure. For many high-growth startups, it's a deliberate strategy to achieve rapid expansion and market dominance. Investment firms, especially in the private markets like venture capital and private equity, operate with a different mindset than traditional stock market investors. They're not looking at quarterly earnings reports in the same way. Their focus is on a much longer horizon and a specific type of outcome. To grasp why these investments happen, we need to understand the core principles guiding private market investment thinking. It's a strategic approach that prioritizes long-term vision over short-term profitability. The first key principle is growth over profit. Many investors prioritize rapid growth in users, revenue, or market share, especially in early stages. Think of it like planting a tree. You spend money on water and fertilizer initially, not expecting fruit immediately, but rather a robust, towering tree in the future. This leads directly into the market domination strategy. The ultimate goal for many of these investments is to become the undisputed category leader. This often involves a winner-take-all mentality. Think about how Amazon scaled for years, prioritizing market share and customer acquisition over immediate profitability, eventually becoming a dominant force. Investors are essentially investing in future potential. They are betting on the company's future cash flows and long-term value creation, not its current earnings. It's like buying tomorrow's profits at today's price, anticipating a significant payoff down the line as the business matures and becomes highly profitable. The exit-driven mindset is paramount for venture capital and private equity. Their focus is on major liquidity events like initial public offerings, IPOs, or strategic acquisitions. They aim for outsized returns that follow the power law, where a few big wins in their portfolio drive the majority of their overall returns. To understand why investors are comfortable with negative P&Ls, you need to look beyond traditional accounting. A startup's success isn't solely judged by current profits. Investors delve much deeper into operational metrics that provide a true picture of the company's health and potential. These operational metrics provide a more nuanced view. They reveal the underlying efficiency and scalability of the business, even if it's currently in a growth-focused, cash-burning phase. It's about understanding the engine, not just the current speedometer reading. Crucial among these are customer acquisition cost, CAC, and lifetime value, LTV. CAC tells you how much it costs to acquire a new customer. LTV reveals the total revenue a customer is expected to generate over their relationship with the company. If LTV is significantly higher than CAC, it signals a scalable and sustainable business, even if it's currently losing money on each new customer due to upfront growth investments. Investors also closely monitor burn rate and runway. Burn rate is how fast a company is spending its cash. Runway is how long the company can survive at its current burn rate before needing more funding. These metrics are vital for managing liquidity and planning future funding rounds. Other core financial health metrics include gross margins and churn/retention. Gross margins show the core profitability of a company's products or services before operating expenses. Churn is the rate at which customers stop doing business with a company, while retention is the inverse. High retention rates indicate a strong product and loyal customer base, which is a powerful indicator of long-term business strength. Investors also delve into unit economics, the profitability of a single unit of product or service, and engagement NPS, Net Promoter Score. These metrics assess per-unit profitability and customer experience to gauge long-term sustainability. A strong NPS and high engagement signal a product customers love, leading to future growth and stickiness. While the high-growth model can be incredibly rewarding, it comes with significant risks. These high-growth models are inherently speculative. Investors are making calculated bets on future scenarios that may or may not materialize. The path to profitability is not guaranteed. Economic downturns, increased competition, or shifts in consumer behavior can derail even the most promising cash-burning company. It's a high-stakes game with substantial capital at risk. In today's market, we're seeing market corrections and tighter due diligence. Inflated valuations from previous bull markets are facing correction. Investors are now applying more rigorous due diligence, demanding clearer paths to profitability and sustainable unit economics before committing capital. So why do investors fund cash-burning companies? It's not about ignoring losses. It's about seeing beyond the immediate P&L to a much larger strategic vision. They fund these companies because they prioritize rapid growth for market dominance, invest in future potential, and focus on massive exit opportunities. They understand that current losses can be strategic investments in a future category leader. Understanding these nuanced investment strategies is essential for anyone looking to enter the world of startups, venture capital, or even just to comprehend how some of the largest companies were built. Remember, this video provides general educational information and is not financial advice. All investments carry risk, and past performance is not indicative of future results. Always consult with a qualified financial professional before making any investment decisions. Thank you for watching.